For anyone in the UK with savings in the bank, the country's first interest rate hike in 10 years is good news. But for people with debts, it spells worry. The UK Central Bank began cutting rates in 2008 in response to the global financial crisis. After last year's vote to leave the EU, it cut them again to 0.25%. Now the Bank of England's increased its key policy rate back to 0.5%. It's concerned that consumer prices are rising too quickly. Now the move sent the British pound sharply lower against the dollar. Sterling had strengthened nearly 4% since late August in anticipation of a rate hike. The bank's Governor Mark Carney says any future increases will be gradual. Katie King is in London and sent this report.
The Bank of England had raised expectations of a rate hike to such an extent it almost had given itself no other option. Odd, you might think, because Britain's economic growth is the slowest in the G8. Productivity has stagnated and wages are failing to keep pace with price rises. But the clincher for policymakers was the rate of inflation, now nudging 3%, well above the government's target.
We must aim to bring inflation back to target and to keep it there once the effects of temporary factors, currently predominantly those caused by the referendum-related fall in sterling, dissipate.
The bank says any further moves will be gradual and limited. It's waiting to gauge the impact of Thursday's rate hike, especially on consumers.
The clarity of communication is absolutely vital. So far, it has had a mixed record on that front, but I think we're looking for ongoing forward guidance to continue in a clear fashion. Policymakers,
as usual, were divided on the decision. 2 of the 9 rate setters said wage growth was still too weak to warrant a hike. But the other 7 decided now was the time to act to keep price rises in check. There's no doubt this decision has been a difficult one. Inflation is way above target, growth is slowing, and there's rising concern about the impact of Brexit on the economy. It's a heady mix which makes monetary policy in the UK just so hard to predict. There were 3 reasons to raise rates. 1, the UK economy, while sluggish, has not slowed to the extent the bank thought likely after the Brexit vote. Secondly, inflation hasn't fallen as expected, even as the pound has lifted from its historic lows. And lastly, and perhaps most importantly, unemployment has continued to fall and now sits at its lowest level since 1974.
It's perhaps better for the bank to be safe than sorry and take a precautionary stance with regard to inflation or wage inflation, rather than wait for the problem to become more entrenched.
Thursday's decision will have a huge impact on businesses and homeowners alike. The bank's reference rate dictates the cost of borrowing for businesses and the affordability of mortgages for homeowners. Whether rates continue to rise into 2018 is the big question. Much depends on how the pound sterling performs. Any further Brexit shocks could change the dynamic, send the currency lower, and usher in a prolonged phase of rate hikes and potentially a period of pain for the UK economy and its consumers. Kate King in London for TRT World.
Let's go into this in more detail now. Joining me from Lancaster is Geraint Johnes. He's a professor of economics at the University of Lancaster. Welcome back to Money Talks, Professor. Now, look,
Hello,
nearly half of British home mortgages are on variable rate terms. Their mortgage payments are likely to go up. How ready are British debt holders for such an increase?
For many of them, it's going to be the first experience of an interest rate hike that they have had. It's the first interest rate hike that the country has experienced in 10 years. And it is an interesting move by the Bank of England. It's one that could prove to be premature. Clearly, the policymakers on the Monetary Policy Committee have come to the view that productivity is not going to recover enough to bring us back to a situation where we have output growth at the kind of levels that we had got used to before the great financial crash. So they're saying, in effect, that we can expect GDP to grow by less than 2% for the foreseeable future, and that they believe that the economy is operating near to capacity. I think that's a very moot point. There's a lot of evidence to suggest that there's still a lot of slack in the economy. After all, wage growth is only 2.2%. compared with price growth of 3% per annum. So real wages are falling. There's still a lot of slack there. There's a lot of people that are in part-time jobs that would like to be in full-time jobs. Plenty of room for the economy to grow. But the Bank of England has clearly come to the view that we are operating near capacity and it needs to make this judgment on interest rates now.
So you do think this is premature? I mean, Mark Carney said that, you know, this is not one and done. It's the start of a cycle, a very slow one, to be fair, but it's still the start of a cycle. So you think this is premature then?
Yes, I mean, it may be that there's scope for interest rates to rise into the future, but the evidence just doesn't seem to be there at the moment. The Bank of England itself has agents that operate around the country, have regular meetings with business people, and the information that we get from the agents' reports is that wage growth is really just not there. You know, the prospects for increased wage growth, it's as flat as a pancake.
Indeed. Now, that was actually the point of view of the two dissenters on the Monetary Policy Committee, 2 of the 9 people that are on that committee. In what other ways do you think ordinary people are going to be affected? Student loans, car loans, all these things are going to go up?
Yeah, clearly the price of money, the interest rate is going to rise, and that will have an effect on people. People who are in debt, who've got mortgages, particularly those on fixed rate, on variable rate mortgages, are going to find that their costs go up. For many of them, it'll be their first experience of having to respond to an interest rate hike in that way, and it will put the squeeze on. And that is, of course, the intention of the policy, to rein back the economy a little. The problem is that with GDP growth of only 1.5%, that reining back of the economy is happening when things are pretty fragile to begin with.
Do you think part of the problem is the way that the UK is counting unemployment? I mean, everyone's been saying, of course, that the unemployment rate is at a 40-year low, but does that number take into account, for example, the number of people in the UK that are, for example, in the gig economy, who are not covered by many of the protections that a standard employment contract would offer them?
Yeah, there are international standards for the way in which you calculate the unemployment rate. So the unemployment rate in the UK is calculated in much the same way as it is in other countries. But you're quite right to identify the gig economy and the growth of relatively insecure forms of employment. A lot of the growth that we've had has been in part-time employment. So we've had an increase of 1.6 million full-time employees over the last 10 years, but we've also had a growth of 1.1 million part-time employees, and of those, about half of them are self-employed. So there's been a great change in the nature of employment, and an unemployment rate of 4.something% doesn't mean the same now as it did 10 or 15 or 20 years ago. There's a lot more slack still left in the economy than would appear from that kind of level of unemployment.
Professor Geraint Johnes, Lancaster University, thank you very much indeed.
You're welcome.
Let us move on now and speak to Guy Anker. He's the managing editor of MoneySavingExpertcom. It's a consumer finance website, and he joins us from London. Guy, great to have you on Money Talks. Let's talk about this rate rise. How is your organisation advising people to deal with this historic rate rise by the Bank of England?
Well, the 2 key things here are for mortgages and people with mortgages and people with savings. With mortgages, there is a sense of urgency to quickly check what your rate is. A key thing is if anyone's on a variable rate, it's almost certainly going to go up. And also, so too could the cost of new deals. Anyone looking for a mortgage, particularly people on their standard variable rates, which is a very expensive way to borrow, time is probably running out for them to grab what's left of the particularly cheap rates that are out there. On savings, now of course a rate rise is good news for savers. It's only a small nudge up, of course. If people who are active savers, it's probably best to wait because they've probably got a decent rate already, see how rates lie in the next few weeks. But if anyone's got a particularly poor account, unfortunately some pay less than 0.1%, they may as well look for a good account now that's easy access, which means they can get their money when they want, and then maybe review their savings again in a month when rates have settled down a bit, because we do expect some movement from the banks.
Guy, I'm going to ask you the same question I asked Professor Geraint Johnes a second ago. How ready are the British people for rising interest rates after 10 years of nearly zero rates?
Well, one of the problems is for say people under 30, they've probably never experienced a rate rise in their economically active life, and I think we've got used to incredibly low rates. So the danger is essentially mortgage holders, particularly, who have got used to 1–2% mortgages. If they start to creep up, that could prove a problem for some people. Of course, others will have the financial backing to cope with it. But I would say rates have only gone up by 0.25%, and the Bank of England has signalled, and there's no guarantees here, of course, that they probably won't go up again for a little while. So we're not in crisis territory. But maybe we've got used to abnormally low rates. They will eventually go up.
OK, Guy, now we've been looking at it very much from the point of view of borrowers. Let's look at it from the point of view of savers for a second. How much of a boost are savers going to get from this rate rise? Banks are passing on, of course, the cost of the increased borrowing to borrowers, but are they going to pass a similar rate rise to people who are saving money?
That's what we want to know. Some of them have said they will pass the rise on to some of their customers. We're doing the digging. Who exactly do they mean? But I don't think people are going to jumping for joy in the streets that suddenly they're going to earn loads of money on their savings. Again, it's a nudge up, and all we are, by going up to 0.5, we're only what we were last August, and back then we were talking about that being a historic low. It's obviously a boost for savers, but it's a small boost. But it's also a moment for people to reassess their savings. If they're in a rubbish account paying less than 1%, change it while it's on your mind. Get a decent account.
How worried are you about the levels of indebtedness of British people right now?
I mean, indebtedness has been a common theme over the last few weeks. Bank of England, government have all said the same. It's for the macroeconomists to look at those things. The key people, households can do is look after their own finances, and that's why the point about this being a danger zone for some mortgage holders, where rates will go up, they will pay more each year. It's very important they look after their finances, get onto a better mortgage rate if they can. But of course, for savers, there's that small little boost.
OK, Guy Anker of MoneySavingExpert.com in London. Thank you very much indeed.